The invisible masters behind global interest rates hook the mystery everyone in finance pretends not to see. Imagine a room with no windows, no doors, and no traditional rulers. In it sit a handful of figures who never appear on CNBC, never testify in Congress, and rarely publish papers in the journals you trust. Yet their influence creeps into every loan, every mortgage, every central bank decision, and every nation's balance sheet. What if the most consequential levers of global money aren't pulled by politicians or famous hedge funds, but by a hidden cadre whose footprints are easy to miss, but impossible to ignore once you know where to look? Tonight, we pull back the curtain on a system that governs trillions. It's a system that shapes whether a family can buy a home or whether a small business can keep its doors open. This is the story of the invisible masters behind global interest rates. Opening mystery scene, we begin with a riddle told in numbers. A country with near-record low unemployment, a stock market at dizzying highs, and yet a stubbornly stubborn whisper of inflation that won't quite vanish. The central bank meets, flags flash on a screen, and the policy rate moves by a quarter point, then another. Markets react in minutes, then settle, then rethink. If rates are the tool, who is wielding it when no one takes credit? The answer, paradoxically, lies not in the room where policy is announced, but in the longer room where capital flows. Expectations are formed and risk is priced. Background history and mystery teased. To understand today's interest rate regime, we must first understand what interest rates are in a broader sense. The price of money over time, a signal that coordinates billions of decisions. Since the dawn of modern finance, rates have been shaped by more than just inflation and growth. They have been influenced by how risk is measured, how credit is allocated, and how capital is moved across borders. Key historical milestones set the stage. The birth of central banking and the move toward policy-driven rates in the 20th century, where governments learned to manage the price of money as a tool of macroeconomic stability. The Bretton Woods era, the long shadow it cast, and the transition to floating exchange rates as financial markets learned to price risk much more dynamically. The rise of global capital markets and the proliferation of financial instruments that connect distant borrowers with distant lenders, turning the rate on a local mortgage into a global conversation about risk, leverage, and liquidity. But behind these big shifts sits a subtler engine, the expectations and pricing baked into the demand for safe assets. The supply of dollar liquidity and the way financial institutions model risk. These are not the headlines, they're the backstage rails on which the entire system runs. Twists teased key figures and systems to watch. The most influential players rarely appear in the morning briefings. Consider a few archetypes who shape the invisible rate. The global liquidity providers, institutions that supply or drain liquidity in short-term funding markets. Their balance sheets and risk controls set the floor or ceiling for a broad class of rates. The liquidity premium whisperers, traders and analysts who price the risk of macro events into term structures. Their consensus can move curves even when official statements don't. The shadow benchmark whisperers, the pretend free-floating benchmarks on which trillions are priced, often binding private contracts more than public policy discussions. The policy communications engineers, officials who both set policy and manage market expectations through careful language, the signaling, and sometimes deliberate ambiguity. The story, however, is not about personalities alone. It's about how a web of incentives, capital allocation, risk management, regulatory framing, and global interdependence creates a feedback loop that reinforces certain rate dynamics across time. Origins, the cause and effect, scaffolding the need for a price of money. Rates exist because lenders demand return and borrowers seek capital. But the modern complexity arises when the world becomes a single capital market. The origin story is a sequence of small but cumulative decisions. Central banks standardizing monetary policy tools, international banks creating cross-border funding channels, and investors demanding a risk-free rate that reflects both safety and opportunity. The echo of risk and the demand for safe assets. When uncertainty rises, investors flock to safe assets, government bonds, high-grade short-term paper. This flight to safety lowers yields on those assets, which in turn lowers the entire term structure of rates. The chain reaction is immediate, as safe assets become scarce. The cost of funding for riskier borrowers rises, which feeds into the broader economy. The currency and liquidity interdependencies. Global markets rely on the depth and reliability of liquidity. Central banks' balance sheet expansion or contraction can ripple through money markets, affecting day-to-day funding rates. This is not just about inflation or growth. It's about confidence in the plumbing that moves money around the world. Rise, the expansion of influence and the feedback loop, the diffusion of central bank policies across decades. Central banks have learned to communicate in markets' language. Forward guidance, asset purchases, chair commentary. Each tool nudges expectations and thus shapes the shape of the yield curve. The growth of cross-border capital flows as capital can be allocated globally with speed. The marginal impact of any single decision can be amplified. A rate surprise in one major economy can reprice risk across continents, especially for institutions with global balance sheets. The development of complex financial instruments, derivatives, securitized products, and repurchase agreements repos enable rapid transfer of risk and liquidity. They also introduce feedback effects. A small move in a benchmark can be magnified by the leverage embedded in the system. The rise of algorithmic and model-driven pricing traders and institutions use models that simulate outcomes under countless scenarios. When many participants rely on the same models or share correlations assumptions, herding can occur, making rates more reactive to perceived risks than to underlying fundamentals. Breaking point when the system strains and reveals its fragility. Liquidity droughts and sudden stop dynamics, periods of market stress can evaporate liquidity. When liquidity dries up, even small shocks can cause sharp spikes in funding costs, which then depress investment and real activity. The rate system, designed to smooth cycles, can instead amplify them. The debt servicing pressure in highly leveraged economies. As debt accumulates, the marginal cost of additional borrowing rises. When rates go up, refinancing risk and rollover risk mount, turning a benign debt load into a potential trap. This cycle can become self-reinforcing if widespread. The policy misalignments and miscommunications, ambiguity or sudden shifts in policy stance can unsettle markets. If traders interpret policy signals incorrectly, corrective moves may lag, leaving the system exposed to abrupt repricing. The constraints of the transmission mechanism. Interest rate policy relies on banks and financial institutions to transmit changes to the broader economy. When banks face balance sheet stress or funding pressures, the transmission slows, blunting intended effects and increasing uncertainty. Fallout consequences that echo through households and firms. Mortgage and loan affordability. Rising rates raise monthly payments for borrowers with adjustable rate or new loans. This directly affects consumer spending, home purchases, and the health of households, business investment, and growth. Higher borrowing costs can postpone or reduce capital projects, slowing productivity growth and potentially impacting employment in sensitive sectors. Financial sector health. Banks and non-bank lenders face tighter funding conditions and heightened risk management costs. The system can absorb some shocks, but sustained pressure can lead to tighter lending standards and reduced credit. Availability. Global inequality and policy dilemmas. Emerging markets can experience capital outflows and currency depreciation when rates rise in major economies. The resulting volatility can hinder growth, complicating policymakers' efforts to stabilize inflation and employment. Failed fixes. Attempts to stabilize the system, and why they sometimes fail. Rate cutting. Cycles and quantitative easing. Central banks have used asset purchases and rate cuts to stimulate demand. These tools can work in the short run, but if overused or mistimed, they risk creating asset price distortions, easing of credit conditions beyond sustainable levels, or a misallocation of capital. Macro-prudential policies. Regulators employ measures to curb excessive leverage and risk-taking. While these can improve resilience, they can also slow credit expansion during weakness or shift risk into less regulated sectors. Global policy coordination. Coordinated actions can stabilize markets during shocks, but coordination is hard in a world with diverse political pressures and priorities. Misalignment can lead to divided responses and unintended consequences. Structural reforms and growth initiatives. Long-term fixes aim to improve productivity and debt dynamics. These take time to bear fruit and can be politically contentious, delaying the desired stabilizing effects. Modern parallels, shocking data, and recurring patterns. Yield curve signals and recession indicators. Historical. Patterns show that yield curve inversions have preceded several recessions. While not perfect, their repeated appearances signal how rate expectations reflect broader macro risk assessment. Liquidity cycles and the hidden liquidity premium. During calm periods, liquidity appears abundant, but when stress hits, liquidity rapidly evaporates. The resulting spikes in funding costs reveal how intertwined liquidity and rates are. The dominance of dollar funding and cross-currency dynamics. A large share of global lending depends on dollars. Movements in dollar liquidity, exchange rates, and funding availability in major currencies can propagate through to local rates worldwide. The distributional effects of policy shocks. Policy changes impact different sectors unequally. Households, small businesses, and large corporations respond differently to shifts in rates, often widening inequality in the short run, even as policymakers aim for broad stability. The feedback loop between expectations and reality markets price and anticipated policy actions. When reality diverges from expectations, shocks can be amplified as investors adjust quickly, sometimes overcompensating. 3 takeaways: the price of money is a product of incentives, risk, and liquidity, not a single knob tweaked by a central authority. Global financial interdependence means a policy decision in one country can reverberate across continents, affecting households and businesses far from the source. Understanding interest rates requires looking beyond headlines to the architecture of markets. Liquidity dynamics, risk pricing, and the transmission mechanisms that connect policy to real-world outcomes. Warning or open-ended thought: if the invisible hands behind rates shape so much of our lives, how can individuals, small businesses, and even small nations build resilience against sudden changes in the funding environment? The answer hinges on diversifying funding, improving financial literacy, and designing policies that strengthen the transmission channels without encouraging excessive risk-taking. If you found this examination of the unseen drivers of global interest rates enlightening like this video, subscribe for more deep dives into how the global financial system works, and share it with someone who should understand why rates move the world. Comment with a question you have about how a specific rate move affected your life, and I'll address it in a future episode. Closing note: the story of the invisible masters is not just about numbers or institutions. It is about trust in the stability of markets and the honesty of policymakers, and in our collective ability to navigate a system where the price of money quietly, relentlessly shapes our everyday choices. Would you like this script adjusted for a longer or shorter length, or tailored to a Hindi-speaking audience with localized examples and terms?